Welcome to the Organized Investor Show with Jerry Goodman and Megan Hubbard from Tennessee Wealth Management. I'm Erik Ainge, host of the Erik Ainge Show on the Sports Animal. We're here for an inside look at how this team coaches their clients to organize their investments, their retirement, and their affairs. I'm going to ask the questions you might have if you were sitting right here with us. And listening will make you a much more informed investor. Hopefully a much wealthier one as well. If what you hear makes sense, you can ask them nicely. They can have a chat with you, understand your situation, get to know you, and see if working together might be a good fit. Megan is a former first grade teacher at CAK and has a master's degree in curriculum and instruction. Jerry is Megan's dad. He was on the professional staff of Price Waterhouse, was a vice president at Merrill Lynch, is a CFP with 43 years of experience, and spends his free time trying to get his golden doodle to eat their food. And, of course, watch the Vols. It's good to be here. Megan, Jerry, you won the toss. The ball's on the 25. You got 3 timeouts. Let's roll.
Thanks again, Erik, for showing up with us for our second week in a row of us being together on the show. So now, before we start talking about organizing a bunch of things, I do have a question for you today. So according to ChatGPT, are you still tied for the SEC record of the most passing touchdowns in a single game?
1,000%. Now, I did it in 4 overtimes against Kentucky. Joe Burrow did it in the first half of a college football playoff game. So, like, 2 things are different, but that is my record. Okay,
well, it looks like you passed for 7 touchdowns against Kentucky back in 2007. Is that right? Okay, so I think Tennessee scored 7 touchdowns on Kentucky this year, but it looks like only 3 of them were actually passing touchdowns. Now, assuming I'm reading all of this correctly and assuming you're paying attention to stuff like this, I would think you would be, considering this is your career, right?
It's his record.
And your record. And does your 7 touchdown record still stand?
It still stands. You can account for total touchdowns, but mine passing touchdowns, 7 in 1 SEC game, that is still a record, guys.
Ooh.
Good for you.
No big deal. It's not a big deal.
Well, if the quarterback runs the ball into the end zone, is that considered a passing touchdown?
Nope.
Okay.
That could be accounting for. So the quarterback could throw 4, run 2, accounted for 6 touchdowns, but only 4 of them would be passing touchdowns. And I only had 1 rushing touchdown in my entire career.
So is that an SEC record?
SEC record, single game SEC record. I still use that when I travel around and like talk to kids or whatever. I'm like, I'll start it off like, I know I'm old. You don't know who I am. I do hold the record for touchdown passes in an SEC football game.
Cool.
Yeah, own it. Take it.
Well, let me say, this is Jerry, Megan's favorite dad. I want to say that the time I have to spend on doing these little radio shows, I'm starting to learn, is rather extensive. I would, based on what Erik does, 15 hours a week, I think, plus. It would take me a week or 2 to get ready for just one of his weeks, I would say. So I think the fact he can do that is incredible. I'm finished sucking up now, but I do have a question. Are some of your friends, are they asking you for stock tips now that you're on this show with us?
They asked me, do you actually know this stuff? And I said, no, y'all, I'm learning it. I'm the sports guy. Y'all are the money people, and I'm learning it with you guys, and it's exciting.
Okay. Well, anyway, so thank you again. We do appreciate you being here. And I guess it's nice that they're not too terribly bad for you. Our grand plan here is to basically get you up to speed on a lot of stuff, to help our clients. And that is a way we really need to take off a vacation week just to kind of fill in for us. Might need to do that at some point. If you're going to take some time off, you can fill in.
So when we were asking you about coaches on the last show, you said the quickest way for the coach of a sports team to get fired is by losing a lot of games and having a bad track record.
That's true. I mean, I guess you could rob a bank, but you are what your record says you are. And I'm actually surprised. You said investors can be pretty slow to, fire their financial advisor, their financial coach. If you're getting mediocre returns, like I said, you are what your record says you are.
They really do. And some of the reasons that this makes sense, for example, it does require a little effort to change advisors, right? This is not something that you're going to just want to do all the time. You need to realize they need replacing. So you've got to identify that. And if you don't have another alternative, you have to actually go out and find one, right? As much as we like hanging out at the radio station with you, the real reason we're actually doing these shows is to educate people. And you even said yourself that your listeners of your radio show actually need to know the difference between mediocre performance and above average performance. I guess that could be, on the football field or in your investments. So we're also going to give them another option to consider. And without having to attend some, steak dinner sales pitch that you might get an invitation to in your mailbox or have to go to somebody else's office, they can just listen from their car.
Well put. And let me just stick in an extemporaneous PSA, public service announcement, that if you get an urge to go to one of these free dinners at the nicest steakhouse in town, please call me and I'll try to talk you out of it. It could be potentially the most expensive free meal you've ever had. And well put, Megan. We also like to share things that a lot of advisors, they're either they don't know them or they're just simply not going to tell you. And since someone's financial coach is not going to tell you seriously what their track record has been, we will. And it can be a way for basically listeners to have a benchmark, some way to compare what they're doing versus something else.
Well, we covered that last show, and I don't recall ever hearing another advisor get around to telling you what their performance has been. And that includes the advisors that I've known for many years. Eric,
and why they don't share this, you can figure it out yourself. But our track record, here we go. We'll go through this. During the first 9 months of 2025, this is through September 30th, we have 210 accounts that we were managing at that point, and they have an average net rate of return of 33.2% a year. We're real proud of that. And to put that in perspective, 33.2% is basically 3.5 times the return to the Dow Jones Industrial Average over that same time frame. And let me add that 33.2% increase. That is the actual value in mathematical percentage terms. That's not the annualized rate of return for just the first part of the year.
And you guys have both said that a lot of people don't know their own performance, what it's been, and they don't fire their advisor. And I was that person. Since the last show, I actually tracked down one of the statements from my account. Like you said, it's not that hard to find, and you just open your mail and you look for it, and you look at it and you go, oh gosh.
So we're glad you found it. And once you have some idea of your performance, you can then actually use that to compare it to whatever you want to compare it to. But here's a novel idea. Why don't you just compare it to what we're giving you, the information that we're providing you here, okay? So let's keep going. For the trailing 1 year period, our average net rate of return was 29.8%. So the Dow was up 9.6%, if that helps you to compare your numbers. That almost is triple what the Dow returned over that 12-month period.
Too bad every year can't be this good, can it? For the trailing 3-year period, our average return of 22.3%, which that exceeded the Dow by 5 points. Our 5-year trailing net rate of return is now up to 18.3% per year, which is over 7 points better than the Dow. And our 6 3/4 year, that's like 6 years and 9 months through September of this year, is at 17.1% a year, which is also 7 points better than the Dow Jones average.
I mean, that's a lot of numbers, but they're also big numbers. You do a 10-page summary from the last show, and it has the returns for all 210 accounts. And that's pretty incredible that you do all this, hence the organized investor, right? But you can think to find this 10-page summary on the investments page on your website. It's super easy, guys, theorganizedinvestor.com.
Excellent. You have remembered our website address and the page that it's on. So you have passed the first test. So let's take just a moment to explain what we mean with, the term materially improving someone's financial future.
It's a hard thing to say.
Yeah, it's a mouthful for sure. But it really does have a big impact on someone's life if they can listen to this and digest this and take this to heart. So, for years, we've used the example that if you can improve your overall performance by just 2% per year on $1 million portfolio, you're going to realize an additional $20,000 per year, which is equal to about $400,000 over a 20-year period.
That wouldn't matter much to Bill Gates, Warren Buffett, or Elon Musk, but most people understand the concept of from a percentage standpoint. What's so magic about the 2% goal? Where'd you guys come up with that?
So this is not going to sound very scientific, okay? But we literally just made it up. I think we talked about that in the last show.
Drew it up in the dirt, huh?
Right. Just came up with a number, pulled it out of the hat. Sounds kind of odd, but the point is that even with a meager, 2% improvement, which seems small, it can actually make a really dramatic change over a long period of time.
That's kind of wild, but I get it, guys. And your returns have been way more than the 2% above the Dow Jones Industrial Average. But do most investors even make as much as the Dow, would be my question.
Honestly, Eric, to tell somebody to use the Dow Jones Industrial Average, I mean, to use that as their baseline to some point, a starting point to compare, that's really being pretty generous because most people have returns that are actually quite a bit less. Not everybody, but quite a bit less. Most people would find, what they've actually been seeing.
Even if you know what your own performance has been, you may not have anything to compare it to. So now you actually do. And since you're not going to remember all of this, I would be shocked if you did, just remember that our 5-year net rate of return is up 18.3% per year.
We all want to know how you've been able to do all this, but I don't know anyone else sharing this kind of info.
Well, here is we call it our elevator speech, our one-sentence summary of how basically this 2% of improvement is even possible. So here we go. We try to find 1% from lower fees and costs, and the other 1% from simply better performance by being more selective with your investments. Now, that sounds a little vague. I get it. But because it's one simple sentence, we had to stuff it all together. But to put it another way, there are fees, like advisory fees, that are oftentimes too high. There are costs that may be buried in some investment. Those could be avoided altogether. And the actual investment performance basically could just be better. So again, reduce fees, avoid costs, try to improve the performance. Those three things.
So what you've explained before, a fee and a cost are two different things in the context of what you're talking about. So if I'm being charged a fee by my investment firm, that may be what is referred to as an advisory account, and you're paying an advisory fee based on the size of the account.
Yes, that is exactly correct. And when we refer to a cost, we're actually talking about the internal costs that, could be buried inside of a mutual fund or an exchange traded fund, annuities, alternative investments. Those are just to name a few. But the cost for the investment to exist. And it's also a cost that a lot of people are unaware of in terms of how much it actually may be.
Well, then who gets to decide what the fee and the cost is? Is it my advisor? Do they have something to do with it? I'm not sure about that.
Good question. Now, if you're talking about the advisory fee, which is like in an advisory account, there are some guidelines that most of the investment firms are going to have to set what that fee is going to be. But in some cases, the actual advisory fee you're paying can be set by the advisor. It kind of depends on the circumstance and the firm and where they are. Not in every case, but in sometimes it's actually set by the advisor. Now, if you're talking about a cost, basically these are the internal expenses buried inside of a mutual fund, exchange-traded fund, or other types of things that basically they're charges to the shareholder to basically manage those investments. So if you own them, those costs basically are going to affect your rate of return.
Well, so my question then, Jerry, Megan, is my advisor plays a hand in what I'm paying for the fees and the costs.
So yes, and while they may not be the one that's actually setting the costs for the mutual fund they invested you in, they're probably the person that suggested you invest in it to start with. They're the ones that gave you the advice and told you that's where your money should go. So they may be playing a bigger part in what you're paying than what you actually are thinking.
And so, Eric, let's go back to the advisory fee for a moment here. We also use through our firm advisory accounts to create these kind of returns. We have to have some platform to do this with. And our advisory fee is usually, it's about 1/4 percentage point less than what other advisors charge. Now, for anybody that might think, well, geez, Charles Schwab is so economical, our advisory fee is actually less than theirs, just to put that in perspective. Also, this may sound a bit strange, but with the level of performance that our clients have seen, the numbers that we've just gone through, we could literally double what we charge and our clients would still be happy. But we're not going to do that because we subscribe to this do unto other mantra with our clients. We're just not going to do it. We're trying to be fair and honest.
Well, that's something you don't hear very often. All right, so just to be clear, I like to the advisory fees based on the account value, and there can be costs within the actual investments like mutual funds or exchange traded funds on top of that. And that's something I probably don't even see. That means you're paying an advisory fee for them to invest your money into a mutual fund that already has a manager and a cost associated with it.
Yep.
So we need to pay attention to our investments to make sure we're not getting nickel and dime to death.
That's exactly right. And, even those small percentages multiplied times, larger amounts of dollars over longer periods of time, that can all add up to be a lot of money.
So if you're listening to this, you think, well, where do you put the money? So we look at a much better option than mutual funds and ETFs, exchange-traded funds. We mainly use higher quality individual stocks that have a history of raising their dividends. And here's why. See, unlike mutual funds, there is no internal cost to own a stock. They're also much more transparent, so you know exactly what you own. You have no idea what's invested in that mutual fund at any point in time. And you have much better control over your taxes when you go to sell these things. On a fund like that, you have no control over it. And you can also, by buying individual stocks, you can be much more selective on where that money is actually invested. In a fund, you have no control over what they're going to put it in.
Well, and I recall your comment that saving that 1% in fees and costs depends on how I'm currently invested, and either I may realize those savings or I won't. So if reducing fees and costs are the first two pieces of the puzzle, what's the third leg to this 2% improvement?
So the third part is about actually improving your actual investment performance. Now, this is not as predictable as the fees and costs portion of this, but there can be a mother lode of opportunity with this in terms of improving your overall performance. And, that's because mutual funds, exchange traded funds, and even alternative investments will actually often have mediocre returns.
So it seems like every advisor on the planet's always talking about investing in a bunch of mutual funds or maybe exchange traded funds, but you're telling me they have mediocre performance. And then performance is not that great. Then why are they recommending them?
Both great questions. So let's answer it this way. First, there are a number of mutual funds out there. There's some that actually have good performance. The problem is when your advisor puts you in 20 different funds that are going to own several hundred stocks each, well, basically, now you're invested in 3,000 to 4,000 companies. You're all over the place.
Well, I think you've said they've gone from diversification to diversification. I do remember that because effectively, you own almost every stock on the planet.
Yeah.
Yes, that is exactly correct. And you don't need to own that many companies to be diversified. People have that in their heads. That is actually inaccurate. Many stocks actually means you own the good ones, but you also own a lot of the not so good ones when you own a bunch of these stocks. So we're going to cover this in more detail, but for now, fees, costs, and performance is where we usually find that 2% improvement.
So Megan and Jerry explained what they've accomplished in terms of improving the financial lives of their clients and how they can use that baseline to compare to your own returns. They've also explained their part and the overall goal of that 2% improvement, from lower than average advisory fees to avoiding internal cost of mutual funds, exchange traded funds, and even alternative investments. When we come back, we'll discuss the third part of that three-legged stool, which involves improving your overall investment performance. I'm Erik Ainge, and this is the Organized Investor Show on News Talk 98.7.
For more than 50 years, families, businesses, and neighbors have trusted one name to make life's biggest moments unforgettable: Rosa's Catering. Family owned, locally grown, serving this community since 1971. And now, Rosa's is taking hospitality to new heights. Literally, inside the iconic Sunsphere, Knoxville's shining symbol from the 1982 World's Fair. Introducing Sunsphere Events. 2 breathtaking floors of panoramic views, elegant gatherings, and the warmth only Rosa's can provide. Whether it's a wedding in the sky, a corporate reception, or a celebration with friends, Rosa's and Sunsphere Events bring people together beautifully. Visit rosascatering.com or sunsphereevents.com to plan your next unforgettable event. Rosa's Catering, a Knoxville tradition since 1971. Erik Ainge is a host of The Erik Ainge Show on 99.1 The Sports Animal, weekdays from 9 to noon. He is not a client of Tennessee Wealth Management, but is compensated to both promote and co-host the Organized Investor Show.
Welcome back to the Organized Investor Show with Jerry Goodman and Megan Hubbard from Tennessee Wealth Management. I'm Erik Ainge, host of the Erik Ainge Show on Sports Animal 99.1, weekdays 9 to noon. If you've just joined us, Megan and Jerry explained that a 2% improvement in someone's performance may dramatically improve someone's financial future, and how they've been able to exceed that for so many clients. For the first 9 months through September 2025, their average net rate of return was 33.2%. That's 3.5 times more than the Dow Jones average in that same time period. 5-year track record is 18.3% return per year, which is 7 points more than the Dow. And this can help our listeners, everybody right now, make a comparison with their own returns and maybe an alternative they should consider.
Great recap, Mr. Ainge. You're passing the class with flying colors. So fees and costs are actually two parts of the three-legged approach for that 2% improvement. And the third part actually involves simply being more selective with where you're investing your money. And this is the area that offers a lot of opportunity for improvement.
All right, Megan and Jerry, you guys charge a smaller advisory fee. You're avoiding the internal costs of things like mutual funds. You're not over-diversified into thousands of companies. And the end result is your returns are dramatically better than other advisors. So tell us what you're doing. Please feel free to keep it simple for people like me. Clear it up.
Well, Erik, first and foremost, we invest in actual common stocks, while most advisors are going to put you in, say, mutual funds, exchange-traded funds, annuities, even alternative investments, things like that. And by doing that with mutual funds and things, you're now massively over-diversified in, let's say, thousands of companies that's probably going to give you mediocre returns. So in terms of what we're doing with common stocks, we divide these into basically two different approaches, and we're going to explain each one of them. Now, the first one is what we call a core strategy, what we typically like to be in most all the time, but we're not. It includes higher quality companies that have a history of raising their dividends.
And to be clear, these are not necessarily the companies that are paying the highest dividends. They're actually the companies that have consistently been raising their dividends, and in some cases have been raising their dividends for even decades. So we call this the dividend growth, and these are usually from the DSIP list, which is created by Wells Fargo Research. Now, this dividend growth strategy is not the most exciting way to invest your money. I get it. But the DSIP list actually has a 30-year track record of 12.8% per year, which was about 1% more than the S&P 500 index over that same time period. And these stocks are generally large, well-managed companies that you are going to be familiar with, like Costco, Home Depot, Walmart, Becton Dickinson, Lowe's, Schmucker's Jelly, one of my family's favorites. These are just to name a few.
When I recognize those companies, I'm a customer of almost every single one of them. It doesn't sound boring to me to get these kind of returns, particularly with companies like that you just mentioned.
Look, we totally agree. And we refer to these stocks as, again, our core holdings that pay a nice dividend that has been increasing like year after year. Now, we understand that because raising these dividends year after year, investors are really attracted to them, and they result in a lot of price appreciation. So if you take that 12% track record that Megan mentioned about the DSIP list, she talked about that, you can basically make a generalization that out of that 12%, let's just say 2% of that return is from the dividend itself, and the other 10% on average is strictly from the price appreciation of the stock going up in price.
And since some of these companies have raised their dividends every year for decades, again, it's a good indication that they're all well-managed companies, okay? So, for example, Lowe's Home Improvement, we're all familiar with that place. They have actually raised their dividend annually for the last 60 years. I did not know that Lowe's was even around, had been around for 60 years.
Even through COVID, which was pretty amazing.
Well, a lot of people did a lot of work on their homes, I think, during COVID because nobody could go anywhere. But there's a lot of people that don't even know that a lot of these businesses have been around as long as they actually have been. Also, you'd expect that investors not only like the fact that the dividends are going up every year, but also that they're more likely to keep these companies, okay? So regardless of what the market does, these companies are going to be hanging around. Even during a market drop, investors may not sell them, which means their stock price is probably less volatile.
Question, when you say a stock price is less volatile, Are you saying these stocks don't get into arguments with other stocks? Are they fighting each other? What does that mean?
That's a cute question. So let's give it a happier description, Eric. Let's say instead of volatile, let's say the prices of these types of companies, let's say they're less bouncy aroundy. There's a technical term for you, bouncy aroundy. So in other words, less volatile means that investors are less likely to sell them, just hold on to them, regardless of what's going on around them in the market. So they have less risk of going down in price.
So less bouncy aroundy means they're not as apt to drop in price.
Yes.
Which seems like that's what we would want, right? And I'd like to be clear, how's that going to help me?
So the fact is that these stocks may not be, as my dad said, as bouncy or roundy than other stocks in the market, which is a really important part of our second strategy, which is what we refer to as bargain opportunities. So these bargain opportunities occasionally occur and are usually triggered by some random event that can temporarily send shockwaves through the stock market. And when one of those bargain opportunities comes knocking on the door, you need to be paying attention and be willing and able to take advantage of them.
So it's like the Kmart Blue Light Special and things are going on sale and it's like, oh my gosh, you have to see this. But I'm not going to see that. That's where you guys would come in.
Yeah, I mean, there's probably an app on your phone that might be an even better analogy than the Blue Light Special on aisle 3. But our very favorite bargain opportunity, at least so far, spring of 2020 when COVID reared its ugly head, we moved a whole lot of money into these boring dividend growth stocks that really hadn't dropped much in price into companies that basically had been affected by COVID. Now, remember when we said these dividend growth stocks that they are less volatile, that's why this is so important. We were in a position to sell some of these dividend growth stocks that had not dropped much in price and replaced them with other things that had gone down a whole lot. So again, we're able to move money from stocks that had not dropped much in price to those that had. And that list that Megan was referring to, it included hotels, restaurants, casinos, airlines, cruise lines, aerospace, credit card companies. It was anything that was kind of travel or hospitality related. That's what we bought, and that's really kind of was a very fun move. We made a lot of money.
Yes, exactly. We actually purchased virtually anything that was travel or hospitality related and, that had dropped significantly in price in the spring of 2020 because of COVID. So at that point, the account effectively had about 1% invested in those 98 different companies, with about half of those in the dividend growth stocks and the other half in the COVID stocks. And as long as there weren't a lot of bankruptcies, and there actually were none, this was going to be a profitable investment decision, which it was.
Well, I'm glad to see something good came out of the whole COVID pandemic, but I guess it was good for y'all, not necessarily the people that sold the stocks to you in the spring of 2020.
Yeah, I feel badly for those people that sold us all that stuff in the spring of 2020, but
not too bad. You bought them.
Yeah, and we're here to look out for our clients, which not them. We're here to take care of ours. So opportunity number 2, that was number 1 with COVID. Number 2 is when we moved a portion of the accounts into basically 13 regional bank stocks. This was a couple years ago, back in 2023. And this all got triggered because several banks went out of business because the sharp rise in interest rates. They got kind of upside down on their bond portfolios and that sort of thing. So this was on a smaller scale than the COVID opportunity, but it was still very profitable, for the amount of money that was involved in it. And again, we were able to move some of this money from stocks that hadn't dropped much in price into these bank stocks that had dropped a lot. So again, this is another example, another reason why having these dividend growth stocks that are, as we said, not so bouncy aroundy, they're not as volatile, but they allow you to move it into other parts of the market at certain times.
And finally, opportunity number 3, which is related to focusing on some of the tariff-affected parts of the market, which occurred in the spring of 2025, so just this past year. This past spring, we actually had a lot of available cash, as well as a number of growth dividend stocks that had not dropped much in price. So once again, we moved the funds into these undervalued areas. Now, as you're digesting this, part of what makes our process so different and our performance so much better is that we have the ability to manage these accounts on a discretionary basis, which actually gives us the flexibility to make changes very quickly. So in other words, our clients are aware of how we manage these accounts, and we don't have to take a week to discuss all of this with the 210 different accounts that we have.
You call an audible. I remember the stock market was scared to death that the tariffs might increase inflation and might even cause a recession. So you were buying on bad news, it sounds like, and your plan is to sell on good news. Pretty simple concept, but not easy to do when everyone's panicking.
It's funny you mentioned the term audible, because a couple of hours ago, I literally got on ChatGPT and I Googled up, remind me what audible is. And I was kind of reminded how something changes and you just have to call out. Eric, how do they hear you when you call an audible? The crowd's raising Cain.
On the road, half the time you got to signal it. Little keywords, buzzwords, but simple to your 210 accounts.
Yeah.
Everyone's on the same page. You can get it done pretty quick.
Sure. Okay. I was curious because I didn't think you could hear anything. But anyway, so that announcement that referenced all the tariff situation triggered, I would say by accounts, the largest overreaction in the history of the stock market. Now, once that happened, and I wrote this down, we literally executed 12,521 trades on a single day. And why I wrote that down, I don't know. It just seemed like, gosh, we've been busy today. What actually happened? Now, since then, we've continued to make adjustments. We're kind of always filling with the accounts in certain situations, trying to make sure that we're in the right area. And that is exactly why we're up over 33% for the first 9 months of the year, which is, again, as Eric mentioned, 3.5 times what the Dow Jones Average has done in that same time frame. Now, at the risk of repeating ourselves, again, owning these dividend growth stocks that are less volatile, less bouncy around if you call it that way, is going to give you a chance, an opportunity to move money from things that haven't dropped much in price into things that have. It's nothing more complicated than that.
So, Eric, these are just 3 examples, and these bargain opportunities will periodically and unexpectedly occur in the market. And the next one will be different than the other 3. Once the opportunities are over and done with, we'll usually migrate back to our core strategy or maybe just moved into high-yielding money market funds. Also, being selective and managing these accounts on a discretionary basis without transaction charges is actually what makes these returns possible. Plus, compared to mutual funds and ETFs, stocks are also more transparent and give you better control over your taxes.
So before we go any further, let's call maybe another timeout. I hopefully have one left. Eric, when you introduced us, you said we're going to help people organize 3 things: their investments, retirement, and their affairs, which we can, okay?
Well, I was wondering when we were going to do that, Jerry. Are we frying bigger fish at the moment? What are we doing?
I never understood what that fish comment actually made, but yeah, I guess we are. We're going to talk about all of them. Some of them are going to probably be even a little different episode, maybe a different show completely. But for the moment, we're mainly just focusing on the investments, organizing the money, where the money is, let us say.
Well, do I need to be concerned if I have enough money to make it through retirement?
You sure do. I mean, it's a good idea to basically do a little bit of analysis to make sure that you have enough cash flow to make it from here to when you actually leave this earth. It's also a good idea to have a will, power of attorney, all of these things. Those are all important. But let me just say, neither one of those 2 things, or doing cash flow analysis on your retirement plan or trying to figure out if you have your will in order and all of that stuff, those are fine, but neither one of them are going to change your financial future like your investments can. That's why we focus on this so much.
Well, and I get that, and I'm not planning on retiring next week. I'm not planning on dying anytime soon, but I realize the sooner my investments are headed in the right direction, the better off my family's going to be down the road. So how does someone know just how much all this may benefit them, and what do you think their next step should be?
Well, this may be an oversimplification, but let me just say, for somebody listening to all of this, your potential benefit is simply going to depend on how your investments are currently being managed, okay? If everything's perfect, there may not be anything to fix. And basically, we're helping you to try to determine if there's some room for improvement. That's what we're here to do. Now, we're happy to review your situation, give you a no-cost, no-obligation kind of summary of what those benefits might end up being. Now, to do that, you can do a couple things. You can upload, say, a recent statement, a copy of your statement to us. And we have a secure upload link. It's a Citrix share file upload link on the investments page of our website. Again, it's theorganizedinvestor.com. You can send it to us that way. You can email them to us, mail them to us, bring them by the office, face-to-face chat, Stagecoach, however you want to get them to. Either way, having a discussion with us, that's really a good first step. And basically, we're going to let you hope. You let us know what you're trying to accomplish and what we think could be accomplished.
We've discussed what it means to materially improve someone's financial future, how much this has helped their clients, and how they've been able to do this for a lot of people. You can stay with us. Next, we're going to talk about what most listeners need to do. Start getting a better understanding of their investments and what they need to do next. I'm Erik Ainge. Stay with us right here on the Organized Investor Show on News Talk 98.7. Stay with us or we'll talk about you.
At the Grimes Agency with Goosehead Insurance, getting a quote has never been easier. With our industry-leading online quoting tool, you can answer a few simple questions and see real-time quotes from over 30 A-rated insurance companies right on your screen or phone, often in less than 30 seconds. The entire process takes about 5 minutes, giving you instant access to real prices so you can make sure you're getting the most competitive option for your home and auto insurance. Your information is never shared, sold, or sent to third parties. Everything goes directly to the local Goosehead Insurance office where Mike Grimes and his team review your results, run your reports, and confirm your final quote when you're ready. Call Mike Grimes at 865-281-1267 or visit www.tn.insure today to experience the future of insurance shopping. The Grimes Agency with Goosehead Insurance. Insurance the way you always wished it was done.
Erik Ainge is a host of The Erik Ainge Show on 99.1 The Sports Animal, weekdays from 9 to noon. He is not a client of Tennessee Wealth Management, but is compensated to both promote and co-host the Organized Investor Show.
Welcome back to the Organized Investor Show with Jerry Goodman and Megan Hubbard from Tennessee Wealth Management. This is Erik Ainge, host of the Erik Ainge Show on 99.1 The Sports Animal, weekdays 9 to noon. If you just joined us, we're having a chat about how this team materially improved the long-term financial lives of their many clients. This year-to-date performance through September 2025 is up 33.2%. That's 3.5 times the Dow Jones Industrial Average. Their 5-year performance is 18.3%. And a performance summary for all 210 accounts is posted on their website, theorganizedinvestor.com. They've accomplished this by charging lower fees, avoiding mutual funds and exchange-traded funds, and instead using two different strategies with higher quality common stocks. Megan, at the first of the show, I mentioned you have a master's degree in curriculum and instruction that you taught a class to first graders at CAK. I guess that makes you the dean of our little college knowledge here that we got going on. So for all of us who haven't been in class for a long time, what are your words of wisdom that can sink into our thick heads over here?
Well, that's a great question, Erik. And, just like I would have spoken to all of my little first grade classes, I would just say to keep it simple, right? I'd never say you had a thick head, by the way, at least not to your face. Now, I would say it to my dad.
There you go.
And I know you've probably heard me say it to my dad, but he's used to that, so doesn't really impact him anymore. Now, first, we're not here to question anybody's intelligence, okay? Your IQ is just fine. Everybody else's, I know, is fine as well. What we're trying to share is knowledge, and the kind of knowledge that helps you make a more informed financial decision. And investing is not about how smart you are. It's about what you know and how you use it.
They used to tell us that winning a football game had nothing to do with ego, right? You needed to be prepared, patient, you needed to be informed. The difference is we all know we had to run, pass, kick, and you need to know when to buy, sell, hold.
It's kind of like your Audible comment a while ago. You need to be able to make a decision. And well put, Erik. Listen to you actually weaving these little sports and financial analogies together like a real pro. You're gonna make somebody a nice financial advisor one day. I can't wait to see this. Just keep in mind that you're going to have to pass a couple of exams, which aren't that much fun, but it'll be something you kind of look forward to if you decide to take the plunge, okay?
It's definitely a learning curve for all this, but I'm doing all right so far. It's kind of like someone told me once their goal was to be as smart as a German police dog, which I thought was an interesting milestone to set for oneself. It's a relief to actually understand what you're doing with all the money that you've made for your clients and letting me and everyone listening be a part of how you explain it.
And we appreciate another voice doing the explaining. We really do. Okay, so how about I make the following offer. And he may hate me for doing this, but for anyone brave enough to listen to all of this, my dad is willing to have a phone chat with you with what I refer to as the ask him anything in 20 minutes phone call. Now, if you can get him off the phone in 20 minutes, I'll be amazed. But because he does have a lot of things he likes to share. But again, it will be a phone call that includes anything you want to ask him. You can even ask him about why he wears flip-flops to every event he goes to except for weddings and funerals.
Well, you got to have low standards if nothing else.
Well, now, assuming you have a pen, and I'm assuming you're not driving a car, maybe you are, but if you are not, don't kill yourself while trying to write this down. But our phone number for our office is actually 865-415-2070, and it actually rings on my dad's cell phone. So you can also prank him if you would like to. You can actually text him at that number as well. Now, the question will be, will he respond to your messages? I'm not certain about that. I can't guarantee that. Okay?
We'll try.
Well, hopefully your phone call doesn't say scam likely when they call. You also can text them at the same number, 865-415-2070, and ask him to call you back. Leave a message. Send a telegram. I mean, get the information. The area code, 865, which spells vol on your keypad, actual proof that the phone company really does have a sense of humor. That means if you want to call Jerry, you can type in vol 415-2070.
And just for the record, I know that I said my dad would give you 20 minutes to ask him anything, but I wouldn't waste your minutes asking him any questions about how to work your iPhone, okay? He does not have an iPhone. He is one of those strange, and I'm sorry if I'm offending any listeners.
Galaxy 24.
A Galaxy S24. I don't even know what that is. It's not very iPhone friendly. He is not very iPhone friendly, and I would stick to questions about things that might help you to retire sooner, not how to work your cell phone. Things like buying a bigger house or going on a trip, or
take a bigger trip, get a nicer car, huh?
Exactly. Or maybe a bigger, cuter dog. So the last time we went dog shopping, we actually came home with 3 golden doodles. Just a little side story here, because my dad didn't want to break up the little set, the little triplet set. So he's very fond of buying things in bulk, paper towels, toilet paper, dogs.
Well, particularly dogs are cute and furry. I mean, you can't leave one there when you take the other two. But anyway, so I hate to think what you two are going to say about me if I wasn't here, but hopefully I can make it through the 20-minute ask me anything phone call without any kind of notes. I'm getting pretty good at answering things. And for the person who finally gets around to finding your PIN, again, just as a reminder, or maybe you pulled off the road, phone number, VOL 415-2070.
Can't get much easier than that unless you could have someone call Jerry for you. I'm not sure how that would work.
So, Erik, you have made a great teacher of the day, particularly since you're new to a lot of this, which some of your listeners might be as well. As you might imagine, it's taken us years to figure out exactly how to do this for hundreds of accounts involving tens of millions of dollars, but we're always looking for better ways to explain things. So, Erik, any suggestions?
Honestly, if you're looking for what I would change, not much. That Ask Me Anything in 20 Minutes call could get interesting depending on who actually makes that phone call. But you said listeners can upload statements with the link on the investments page on the website, theorganizedinvestor.com. Seems pretty easy. There's also email, regular mail, stop by the office, come by for a chat. It seems like a no-brainer to me. You're not going to charge them anything, get some feedback. So you've made it pretty simple, which I like. But tell us what you all usually see when someone's looking for all this information.
When the statements roll in, whatever way they happen to get there, most of the time, most of what we see, an advisor is going to have that account invested in, let's say, 15 or 20 different things. They're usually going to be either like mutual funds, exchange-traded funds, maybe even alternative investments. We said this earlier in the show. It's usually an advisory account where they're charging a fee to allocate your money into some of these investments, some of which are actually already being managed and have a fee associated with it. So the advisor is obviously not managing some of those types of actual investments, since there's a portfolio manager like at a mutual fund who's managing the thing. So in a lot of the time, that advisor has even delegated the investment selection process to their firm. They're not even the ones picking those investments.
So it also sounds like, someone's financial coach, it might not actually be doing that much. I assume the advisor's getting paid one way or the other. What are they actually doing?
Yes, for a lot of financial coaches, that is a really good question. What are they doing? And yes, this might sound a little harsh, but in terms of what we just described, they may be doing nothing more than being a salesperson who is being paid to talk you into doing things. They'll help answer questions and guide you through the process of becoming a client at their firm, but I'm not really sure that they're doing much more than that sometimes.
Many times they're not. And if you're invested in one of these advisory accounts that has you invested in, let us say, mutual funds or exchange-traded funds, those sorts of things, a common trait will be mediocre returns, okay? And that's because, we said this earlier, you're probably over-diversified into thousands of different companies, and there's an internal cost buried inside of that most people, they're not even aware of. So you can avoid those same costs when you use, like what we do, take the avenue of using actual common stocks for those investments.
So you're looking at it from the inside out, and you're telling us things that I've never heard before. So how about giving us a couple examples of strategies an advisor may recommend to their clients that you would avoid?
Okay, so for the first one, on the investments page of our website, there's a summary of a mutual fund advisory program called FundSource. It's dated June 30th, 2025, and page 5 actually shows the performance of 9.85% for the past 5 years. Now, if you assume a 1% advisory fee was charged on that, and the 5-year net rate of return is down to 8.85% at that point, okay? So our 5-year net rate of return has been 18.3% per year, which is more than double that. And part of the difference is because there's a 0.78% internal cost shown on page 7.
So for me, Erik Ainge invested in some type of mutual fund advisory account. You're telling me I probably wouldn't be happy with it. And what's 0.78% cost?
Well, since you ask, and to make the math rather simple, let's go back to like our little $1 million example. If you put $1 million in that mutual fund advisory model that Megan just mentioned, the internal cost, which is, she said it was 0.78%, that means that $1 million portfolio to invest in those mutual funds is going to be $7,800 per year. That's per year. That's over a 20-year period. If you extrapolate it out, that's $156,000. And that doesn't even assume any type of inflation. And that cost is in addition to the advisory fee that you're also being charged. Now, if you compare that example of, let's say, 8.85 for that 5-year period to our 18.3% return, you get a real quick idea as to what mediocre performance actually looks like.
And to explain the enormity of this, according to the Investment Company Institute, the value of all mutual funds and ETFs is in excess of $30 trillion. Nobody really knows just how much of that is actually invested within a mutual fund advisory account. But if you consider different versions of these mutual fund advisory accounts spread across every investment firm in the country, it is a huge sum of money. And the most common traits are the high costs and mediocre performances of these investments.
Okay, so hearing all this, why are so many advisors recommending these mutual fund advisory accounts if there's better ways to invest money? Do they not have the ability to manage the account like y'all can?
There may be some reasons why a financial coach, can't actually do this from an operational standpoint. But our guess is the main reason they suggest mutual funds is because they don't have to do much, okay, in terms of making decisions. They basically put the money in and the firm takes care of most everything for you.
So the financial coach is getting paid and they don't have to fiddle with investments. Again, what are they doing?
Pretty much.
So look, we understand that some investors may love this type of a mutual fund advisory account, okay? But part of the reason is because they don't have anything to compare it to. Now, without even looking at someone's investment statement, or our educated guess is that if you're invested in a mutual fund advisory account, that your performance has probably landed in the range of about 8 to 9% per year, okay? That's just a guess, obviously, and, sure, it's not terrible. 8 to 9% is not the worst return. However, it is about half the return of our clients, what our clients have seen. So our 5-year track record through September 30th of 2025 is actually up to 18.3% right now, which is more than double a 9% rate of return.
Well, and given the choice, most people would prefer the higher rate of return than the lower one. But of course, you got to know about it. So that's the reason the three of us are in front of you in these microphones, sharing just how much your clients have improved their financial lives in recent years, and particularly this year to date, 33.2%.
been a good year. Now, you asked for examples. Second example of something that we frequently see and we also always avoid would be alternative investments. Like an example would be Blackstone Real Estate Trust. I mean, there's a fair amount of that invested in this town. So there's a copy of their summary on the investments page of our website. We seem to have everything there, don't we? And it shows that as of June 30th of 2025, that Blackstone 5-year track record was 10.4%. So once again, if you assume there is a advisory fee of 1% that's going to be backed off that, now that net return is down to 9.4%.
While this is not terrible performance, by comparison, again, our 5-year net rate of return is 18.3%, which is almost twice as much. And keep in mind that alternative investments can actually have a much higher cost than even mutual funds. So Blackstone may take up to 5 years to completely withdraw the funds, which makes it rather illiquid when you need the money fast. And it can make your tax returns more complicated, which may increase the CPA fee. So then you're out that money. Basically, advisors like to refer to Blackstone as a private equity investment as if that's a guarantee of some fabulous return, which hasn't been the case typically.
And as I'm listening to all of this, do people ever think that you're like criticizing the advisor? I get that with football sometimes. I would expect someone out there thinking, "Wow, I love my advisor. He's a great guy." You can be friends. Like, what would you say to the person that feels like you're attacking their advisor right now?
Okay, so in terms of them being a great guy or maybe even a great girl, I'm sure they probably are. I don't think that advisors are trying to purposely be deceitful or misleading or they're not kind, but sometimes they're just not giving you all of the information for whatever the reason might be. And, we're talking about your financial future here. This is not a personality contest. So we're explaining a process that for some will have potential long-term benefits that will literally total in the hundreds of thousands of dollars. And on average, we're up to 33% year to date. So what is 1/3 of the value of your portfolio? And with all due respect to the financial coach that you have, if you're hoping that they are ever going to offer these same pieces of advice and suggestions, now would probably be a good time to lower your expectations.
I saw that one time on a gift package, and the outside of the gift package said, now would also be a good time to lower your expectations. I thought that was quite funny. But Erik, since you are helping everyone climb the learning curve on all of this and doing such a great job, we thought your listeners from the Sports Animal or wherever they may be coming from would enjoy you hearing explain all this legal stuff that everybody just loves to hear.
I feel like I'm being punished when it comes to this part of it. All right, so
you are.
Here we go. So the returns for each client's accounts discussed can vary based on the client's individual circumstances, such as when they started the account, what their investment objective was, etc. The rates of returns for these advisory clients was compiled from a month-in performance report for each of the 210 accounts, respectively, and the team has a lot of boring documentation to back up these stats if anyone's interested. This is Erik Ainge with Megan Hubbard and Jerry Goodman right here. Second episode of the Organized Investor Show on News Talk 98.7. We're here every Saturday at 11 a.m., Sundays at 9 a.m. for more ideas on how to become an organized investor. You can also find other episodes on their website, theorganizedinvestor.com, or your favorite platform by searching The Organized Investor. Follow us on social media, YouTube, LinkedIn, X. Save your favorite podcast player, The Erik Ainge Show. You find it, and you can receive the reminders for future episodes.
Excellent job,
How'd I do?
Erik. Good job. You get a gold star.
Set hut.
The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of the Organized Investor or Tennessee Wealth Management. The content has been made available for informational and educational purposes only and is not intended to be a substitute for professional investing advice. Erik Ainge is a host of The Erik Ainge Show on 99.1 The Sports Animal, weekdays from 9 to noon. He is not a client of Tennessee Wealth Management, but is compensated to both promote and co-host the Organized Investor Show. Opinions expressed are subject to change without notice and are not intended as investment advice or solicitation for the purchase or sale of any security. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning or before before making any investment decision. And please consult legal or tax professionals for specific information regarding your individual situation. Brokerage and advisory services are provided by Tennessee Wealth Management through Prospera Financial Services Incorporated. Member FINRA SIPC. The Organized Investor is a brand name operated by Tennessee Wealth Management for educational platform purposes.